Moving average are a very popular indicator thanks to its simplicity. This indicator is used by everyone, from novice to professional, as it represents a significant information resource. We will look at the definition of moving average, then we will review the different moving average, how to set them up, and how to interpret this average thanks to the signal they generate. Finally, we will confirm this first analysis attempt with other indicators such as MACD and RSI. Moving average are an indicator that reflects the average of valuation of stock over a given period that will depend on your trading technique, short-term or long-term. Moving average are ideal for identifying a stock's cyclical nature, new trends, and their reversal. This indicator helps to filter out market noise that could distort your appreciation. That is really important. As I mentioned earlier, this indicator is temporal. It depends on a given period of time that will be more or less long. The choice of the reference period is an important aspect, as it will determine its exposure to price fluctuation. The shorter the reference period is, the more volatile the moving average are. And conversely, the longer the reference period, the smoother the moving average will be and more they will filter out market noise. Note that there are different moving average, so the way to get the moving average that correspond to your needs will depend on the calculation method used. So depending on the weight you want to give to the different value, we will find different moving average such as arithmetic, weighted, exponential, and other. The arithmetic moving average is said to be simple. It's calculated by adding the value of a share and dividing by the number of periods defined. Therefore, this moving average is neutral. It does not give importance to particular value. Each value has therefore an equal weight. This is the particularity of this average. It brings certain advantage and of course certain precaution to know. You can see its formula, it's really simple. So here, V is the selected value. Example, the opening or closing value of a share. And P, as you may know, is the period, so the number of units used. Generally, you can use per 5 sessions, 10 weeks, or 50 weeks. Let's take a concrete example of the arithmetic moving average calculation with the Microsoft share. We have on the left column the price of Microsoft value. The price, as I said earlier, can be either the opening or the closing price. So it will be depending or according to your setting. The latest price at the N value 183.66 being N minus 1, so yesterday. The simple moving average setting. As the formula shows us, we have two factors to set up, V and P. Regarding V, you are advised to use the closing value as more representative of the value of a share. It will allow you to avoid the noise caused by the volatility of a share at its opening. Regarding P, the period selected will depend on your trading strategy. In practice, for the short term you will select a period of 5, 10 or 20 sessions, while for the long term you will select a period of 10, 20 or 50 weeks. Note that these periods are not antagonist. It's possible and even recommended to create two averages with a short-term characteristic and the second one with a long-term characteristic in order to compare them. They will be useful way to identify signals. Firstly, in order to generate signals, we use two arithmetic averages of different periods. A short term of 20 periods which is quite volatile, and another one, a longer term of 100 periods, which smooths the fluctuation of the price and therefore may have the role of support or resistance depending on its position. We notice that these two curves are likely to cross a few times. It's at this intersection that the optimistic and negative signals are generated. On May 4, we see that following a bearish trend, the short-term SMA crossed the long-term SMA on the upward side. What does it mean? It simply means that the short-term trend is more optimistic about the upward price trend compared to the underlying trend. We can also see that the three curves are logically aligned. Firstly, the share price, then the short-term moving average, and finally, the long-term moving average. We can see that this optimistic signal is confirmed by an increasing trend until the next signal on May 6. On that date, we have a twist, a double crossover. This signal suggests that there is uncertainty about the price trend. As we can see later, from May 6 to May 11, a twist between different curves, so we are in the range area. What is a range area? It's a period of constant uncertainty about the evolution of the price. It's important to know that a range zone generally occurs before major market reaction, like an acceleration of the upward price movement or conversely a market reversal. It can be interesting to take a buy or sell position during this range, but it's important to know that the risk is therefore higher. It will become essential to use other indicators to help us to take a position. Finally, on May 12th, we have a reversal of the position of the curves, with the short-term SMA crossing the long-term SMA downward, which predict a likelihood of the future downward trend. Here, we have a visibility of the price over a period of 2 weeks, so it's quite simple to dissociate an optimistic, pessimistic signals from a range zone. So how to differentiate them? Basically, the angle at which the two curves intersect is important. We can see that on May 4 and May 12, the crossing angle was much more significant than those we had during the range zone. However, as I think you have noticed, the signals are quite delayed regarding market movements, so we don't benefit from the opportune moments to act and take a position, only underreacting. In order to improve the sensitivity of the signals, it would make sense to value the most recent price, which is why we will use also the exponential moving average. The exponential moving average. The exponential moving average gives more weight to the most recent value. Concretely, within the calculation of this average, a portion of the current value is added to the previous day moving average value. Thus, the most recent value will have more weight. You can see how the formula is composed. V is the selected value, so it's the opening or closing value of a share. And P, it's the period, the number of units used, generally 5 sessions, 10 weeks, or 50 weeks. Logically, the exponential moving average is therefore more representative of the current value of a share. Because of its nature, it's therefore essential for the swing trading technique. Let's see the exponential moving average setting. As the formula shows us, we have two factors to set up, V and P. Regarding V, you are advised to use the closing value as is more representative of the value of a share. It will allow you to avoid the noise caused by the volatility of a share at its opening. Regarding P, the period selected will depend on your trading strategy. Typically, because it's based on the most recent share price, you will select a period of 10 to 25 sessions according to your preference. However, this indicator can be duplicated for long-term purpose, so you will use P between 50 and 200 sessions. The disadvantage of this moving average is important to highlight. The exponential moving average assigns a higher weighting to the most recent value. This makes it more sensitive to market noise, so in order to reduce the risk of a distorted appreciation, it's essential to combine it with other indicators such as MACD, Bollinger Bands, and others. In order to obtain more content to analyze, we are looking here the Microsoft stock over a slightly longer period, almost a month. We find the two curves resulting from the previous arithmetic average and a new curve which represents the exponential average set at 10 sessions. You will easily find the corresponding average thanks to the legend under Microsoft Corporation name. This is clearly noticeable. Compared to the arithmetic moving average, the exponential moving average reacts more quickly to fluctuation, which is a considerable advantage that has to be balanced against the probability of noise disruption and false indication. We can see that between April 2 and April 5, the different curves intersect successively within a short range. As previously explained, we later observe an acceleration of an upward trend starting on May 6. What happened at the market opening? The different curves suddenly returned to an optimistic position. Gradually, the price curve, followed closely by the exponential moving average curves. Then, we find the short-term simple moving average, and finally, the long-term simple moving average. Significantly, the exponential moving average crossed the two other indicators in an increasing trend, with a significant break of the resistance line represented by the simple moving average 100. Here, the angle is significant enough to confirm an optimistic trend in the medium term. We can see that despite a slight correction on April 13, this trend remains solid for about 20 sessions. Secondly, from April 21, Microsoft price is a rather weak upward trend because we are witnessing a repetition of twists between the indicators as well as a placement of the price curve below the short and medium term indicators. Afterward, this trend starts to waver within a range for a few days, before finally knowing a probable reversal of trend on May 12. This trend reversal is signaled on May 12 by the breaking of the support line and a reversal of the position of the curves. It should be noted that the angle of intersection between the two is not significant enough to certify a sustainable trend reversal. In order to confirm this probability, this is necessary to use other indicators such as the moving average convergence and divergence, and the relative strength index. Thus, here is the summary in order to identify and understand the different signals obtained in the analysis we have just carried out. For the upward trend, firstly, the proper order of the curves must be respected. We will find in the orders the value of the shares, the exponential moving average, then the simple moving average set up in the short term, And finally, the simple moving average setup in the long term. Also, the inclination of the curves must be ascending. Then, note that the crossing angle of the two averages is important. Regarding a flat trend, we are faced with a succession of crossing, a twist of stock value and average. We are here in a range zone. This range zone describes a neutral market that can be concluded with a bull market rebound or trend reversal. Finally, regarding a downward trend, contrary to an optimistic market, we will see a disruption and a reversal of the order of the curves. In addition, the inclination of the curves will reverse significantly and will be decreasing. In the same way, the angle of intersection of two averages is important in order to understand the sustainability of the signal.